Hello everyone, welcome back to another video. In today's lesson, you will learn to prepare the journal entries for interest expense and the bank loan when multiple time frames are involved. You will see the question on the left hand side of your screen, and on the right hand side we have all the workings which I'll go through step by step. This is a very important question for your exam, so make sure to focus and follow through the entire content for an excellent understanding. So with that being said, let's begin. John runs a business selling children's toys. On 1 October 2023, John Trading obtained a bank loan of $90,000 from OBB Bank at an interest rate of 5% per annum. The loan is to be paid equally over 9 years. The partial principal sum repayment and the interest payment are to be made every 30 September. So what we can understand based on this paragraph is that on the 1st of October 2023, John took a bank loan of $90,000 and the interest rate on this bank loan is 5% per annum. This loan is paid over 9 years and it's paid in equal installments, which means every year we're going to pay $10,000 and that's going to be $90,000 paid altogether over 9 years. Okay. We also know that the first loan repayment is going to be on 30 September 2024, which is 12 months since the loan was taken on the 1st of October 2023. We also know that every 12 months, together with the loan repayment, we will also pay the interest expense that we have incurred for the entire 12 months. Okay. The financial year of John Trading ends on 31 December. So we are working with a business where the financial year typically starts on 1 January and it ends on 31 December. Okay. Now, the requirement of the first question is to prepare the journal entries for the following transactions. Adjustment of interest expenses on 1 January 2024. All right, so be careful of the time that we have been given in this question. So 1 January 2024. All right, so for that to happen, we first need to look into what's going on since the loan was taken. The loan was taken on the 1st of October 2023, and the financial year that would have ended after the loan was taken would be on 31 December 2023. So we are now looking into the 3 months of October, November, and December. Okay. We know we have taken a bank loan of $90,000 and the interest expense that we have incurred during these 3 months of October, November, and December is calculated by using the given rate of 5% and multiplying it with the bank loan amount of $90,000 and then further multiplying with 3 over 12. Why we are multiplying with 3 over 12? Because the 5% in itself is an annualized rate. This rate is valid for 12 months. So when we multiply by 3 over 12, we are actually converting our answer into a 3-month value. Okay. And these 3 months are referring to the months of October, November, and December. All right. So altogether, the interest expense that we have incurred for the 3 months of October, November, and December 2023 is $1,125. And we know for sure that at 31 December 2023, $1,125 is still accrued, which also means that it hasn't been paid using cash. Okay, and this is very important here. Now, if I want to ask you a question before we answer the question given in the first part, which is A, my question to you is, what's the journal entry on 31 December for this interest expense that we have incurred? So we would debit the interest expense by 1125 because when expenses increase in a financial period, we debit it, okay? And then we will credit the interest payable or the accrued interest by 1125. And the reason we are crediting interest payable is because by default, all liabilities when they increase should be credited. And that's the main purpose of crediting interest payable here, all right? Okay. Now, the purpose of knowing this journal entry on 31 December is you may have done this before. We cannot leave our expense accounts with any balance at the end of the financial year. It must be reset to zero. All expense and revenue accounts must be reset to zero at the end of the financial period because we want to start the new period with a zero balance for expenses and revenues. This is mainly under the accrual basis concept, which also follows the concept of matching accounting concept, where the profit is calculated accurately based on the revenues earned and the expenses incurred in a typical financial period. Okay, so therefore we must make sure that at the end of the financial year all expenses and revenues are set to zero, so that we do not carry forward this into the new financial period and double count our expenses and revenues. Okay. All right. Now, having said that, we understand that this interest expense account would be transferred as a closing entry to the income summary, and therefore this interest expense account in itself would be reset to zero. So what we will be left with is going to be the interest payable account. So the interest payable account is what will be carried forward on 1 Jan 2024. So at 1 Jan 2024, let's see what's going to happen. So on the left-hand side, you will see that I have a ledger account outline for the interest expense. And this is the interest expense account for the year 2024. I want to show you what's happening on 1 Jan 2024. So on 1 Jan 2024, we have an opening balance, which is 1,125 reported on the credit side. The reason this is on the credit side is because at 31 December 2023, we had interest expense payable, which was a current liability. That liability gets transferred in the next financial period on 1 Jan 2024. And all liabilities by default should have an opening balance on the credit side of the ledger account, which is what we are doing within this interest expense account. Therefore, in the details section, I would be writing interest expense payable. Okay, so interest expense payable recorded on the credit side of 1,125 as the opening balance, and the net balance would be 1,125 credit. So based on this entry, which we have done within the ledger account, if we now look into the journal entry at 1 Jan 2024, we are crediting the interest expense by 1,125, and we are doing that by reducing the liability balance, which we originally had at 31 December 2023 of 1,125. So because we are reducing the liability balance, it's becoming debit. And within this interest expense account, you can clearly see that the first entry is recorded on the credit side, which means interest expense is being credited here. And that means that interest expense is being credited by 1,125. Okay, so this is the first set of journal entry at 1 Jan 2024, which refers to the adjustment of interest that we still had accrued from the end of the previous financial year at 31 December 2023. So let's just fill this in within the table that we are given here. So we would be debiting interest payable by 1,125 because our liabilities are going down. Technically, when we are transferring it to the interest expense account, and then we would be crediting the interest expense based on what we understand for our entry, which we have done within the ledger account. All right. Okay. Now let's look into the second part of the question. So the second part of the question has to do with payment of interest expense on 30 September 2024. All right. We know that we are making our first loan repayment and our first interest payment on 30 September 2024, which is 12 months after the loan was taken, which was on 1 October 2023. Okay? All right. So let's scroll back up to the question so that you know what's going on. All right. So to begin with, we are starting a new financial year on 1 Jan 2024. So what we're going to do is look into the first 9 months of 2024, which is from 1 Jan 2024 until the end of 30 September 2024. And this is mainly because we know there are some adjustments happening within the loan at 30 September 2024. So we want to calculate this within multiple time frames. So there's a loan repayment of 30 September 2024. And the amount of the repayment is $10,000, which we have derived basically by dividing the loan amount of $90,000 over the 9 years of repayment, so which gives us $10,000 as the repayment every 12 months or every year. So the interest expense that we have incurred during this first 9 months of 2024, starting 1 January 2024 and ending 30 September 2024, is the annual rate of 5% multiplied by the loan amount of 90,000, which we had originally, and then multiplying it further with 9 over 12. The reason we're multiplying it with 9 over 12 is because the 5% in itself is an annualized rate. So we're adjusting it by multiplying with 9 over 12, which basically refers to the 9 months from Jan until end of September 2024. Okay. And that gives us an interest expense incurred amount of $3,375 at 30 September 2024. All right. Now, at 30 September 2024, we know we are making the payment for loan and also interest. So we have already looked into how much we are paying for loan, which was $10,000. But how much are we going to pay for interest expense at 30 September 2024? So we will pay the $3,375, which is for the first 9 months of 2024, plus, if you recall, we started the year with an opening balance of $1,175 for interest payable from the previous year, right? Which are for the 3 months of October, November, and December 2023, right? So these two together will be paid at 30 September 2024. And altogether, we will be paying $4,550 as the total interest at 30 September 2024, which is basically all the interest since 1 October 2023, okay? And this will be paid using funds that are available in the cash and bank account, all right? So if we are using our funds available in the cash and bank account, that means our cash and bank account is going down in value. Cash and bank account in itself is an asset account. So when assets go down in value, what do? We have to credit it. So we will credit the cash and bank account by $4,500 in the journal entry, and we would debit the interest expense by $4,500 because all this $4,500 basically refers to expenses, right? So the journal entry that we will have on 30 September 2024 is to debit the interest expense by $4,500, and we will credit the cash at bank account by $4,500. All right. Now, just for curiosity purposes, I want to input this entry within the ledger account that we have done earlier. So what we understand based on this entry is that interest expense account is being debited at 30 September 2024. All right. So let's scroll back up. So at 30 September, we know the interest expense account is being debited. So we will record the 4,500 on the debit column, and that's being debited because of the funds we have used from our cash and bank account, right? So what would the net balance be at the end of 30 September? So we had 1,125 credit before. Now we have 4,500 debit coming into play, which means we have to subtract. We have to find the difference between 4,500 and 1,125, which is going to be 3,375 debit. Why debit? Because we now have more debits than credits, okay? All right, so this wasn't really necessary for the question, but I'm doing it so that in case there are other ledger accounts that you may need to do in your class or in exam, you know what to do, okay? And you can check out my other videos where I have gone through similar stuff, maybe the last 2 videos that I've uploaded. All right, so that takes care of the question number 2, which was the payment of interest expense on 30 September 2024. Now we will look into the repayable of loan at 30 September 2024. All right, this is pretty straightforward. We know at 30 September 2024, we are paying off $10,000, which was basically $90,000 divided by 9 years, okay? So when we pay the loan, what's happening? How do we journalize it? Bank loan in itself is a non-current liability, okay? When you are paying a portion of this loan, your non-current liabilities are going down. When liabilities go down, we debit them, okay? So we are debiting the bank loan, as you can see, which basically reflects the fact that liabilities have gone down. And we're crediting cash at bank because you are paying off this loan using your funds available in the bank account. And bank account funds in itself are asset. So when the asset goes down, you have to credit it. So we are debiting the bank loan, which basically reflects the reduction in liabilities, and then we're crediting the cash at bank account, which shows the reduction in assets. Okay, so this is the journal entry with regards to the repayment of loan. So we will debit the bank loan by 10,000, and we will credit the cash at bank account by 10,000. All right. Okay. Now let's move to part 4. So part 4 wants us to do the journal entry for the adjustment of interest expense on 31 December 2024. Okay. All right. So I'll just take you back to the question. So let's see what's going on. Now, we know at 30 September 2024, we have paid $10,000 for our loan, okay, as repayment. So after the repayment was done, the loan balance, how much would be the loan balance? It's the loan balance on 1 October 2024 after the repayment is the difference between $90,000 minus $10,000, which is $80,000, okay? Now, we want to calculate interest for the remaining 3 months in 2024, which is the month of October, the month of November, and the month of December. So interest expense, we want to calculate for the 3 months of October, November, and December. So that's 5%, which was the annualized percentage, multiplied with the loan amount of 80,000 this time, because we have already paid of 10,000. So we are starting 1 October 2024 with a loan balance of 80,000. And then in this case, we're multiplying with 3 over 12 because we're referring to the 3 months of October, November, and December, which basically takes care of the adjustment necessary for the 5% annual rate. So that gives us an interest expense of $1,000 for the 3 months of October, November, and December combined. All right. So how do we journalize this? We do know for sure that this $1,000 is accrued, which means it hasn't been paid for using cash at 31 December 2024, because we only make the payment for interest once, which is every 30 September. So 30 September already has passed where we had taken care of some payment, but now at 31 December 2024, we have $1,000 of additional interest expense incurred, which we still haven't paid yet, and therefore this is an accrued interest expense or interest expense payable, which is also a current liability. So how should we journalize this? Because we know for sure that this is a liability, and we also know for sure when liabilities increase, we credit it. So we are crediting the interest payable by 1,000, which reflects the increase in liabilities. And we also at the same time increased our expenses for the business. Therefore, when expenses go up, we debit them. So that's why we're debiting interest expense by $1,000. Okay. All right. So let me just fill this entry within the space of the table given here. So we are debiting interest expense by $1,000 because when expenses go up, we debit them. And we are crediting interest payable by $1,000 because interest payable in itself is a current liability, and when liabilities increase, we credit them. Okay? All right. The last part of the question wants you to do the journal entry for the closing of the interest expense account to the income summary on 31 December 2024. All right. If you recall, earlier today, when we first started this lesson, we discussed about all expense and income accounts and revenue accounts being reset to zero at the end of the financial year, and which is basically the closing entries that we perform. This is mainly done because we want to start the new period with a zero balance for expense and revenues, and that helps us calculate the profit accurately and avoid any form of double counting. This is mainly following the accrual accounting concept, or you could also say this is following the matching accounting concept, which basically calculates profit based on the revenues earned and expenses incurred in a given financial period. Now, I want to close the total amount of interest expense in this entire financial year of ending 31 December 2024. We understand that we're working with a business where the financial year starts on 1 Jan 2024 and ends on 31 December 2024, which means we have got 12 months altogether. All right? Okay, so we have got 12 months altogether. In these 12 months, what's the total interest expense that we have for this financial year? It's basically $1,000 for the last 3 months of October, November, and December post the repayment of loan, plus 3,375, if you recall, for the first 9 months of 2024, which is basically since 1 Jan 2024 until end of 30 September 2024. So I believe you have taken notes and practice with me as we were going through the question, but I'll scroll back up and you will see that for the first 9 months of 2024, the interest expense that we have calculated was 3,375. Okay, so the total interest expense when you prepared the statement of financial performance, or the profit and loss statement, or the income statement, whatever you want to call it, how much will you report for interest expense? You would report 1,000 for the last 3 months of 2024, plus the 3,375, which is for the first 9 months of 2024, which altogether gives us 4,375. Okay. Now, how do we prepare this closing entry? When we want to prepare the closing entries for any expense accounts, we have to reduce the expense accounts first. We know by nature or by default expenses are debited. So when we have to reduce it, it will be credited to reflect that reduction. And what we will be reducing it against? Always the income summary, which is basically transferring this amount to the profit and loss statement. So we'll debit the income summary by 4,375 and we will credit the interest expense by 4,375. And this is in fact valid for any expense accounts that you want to close at the end of the financial year. It could be depreciation, insurance, rent, whatever it is. You'll always debit the income summary and you will credit the relevant expense account. So let me just fill those in within the table. So we will debit the income summary and we will credit the interest expense. Okay. All right. That's it. That's all for today's question. I found this question to be a bit complicated, but I believe with a lot of practice, you will only be able to get better and also ensure full marks for yourself in the main exam, which is obviously what you're after. So if you want monthly coaching from me, there's a link in the description where you can book a free Zoom call and you will bring your parents and we can have a discussion regarding your requirements and how we can help you ace your exams at the end of this year. So with that being said, I'll conclude today's video and I'll see you in the next lesson.